a little bit. Hello, everyone. I have the privilege today to introduce one of my colleagues, Matt Molnar, from our Power Information Network. So if you've seen in the agenda, the PIN auto forecast. PIN stands for our Power Information Network, which is a contributory database of information we get from the automotive industry. And for now going on 30 years, we built layers and layers of analytics on top of that. When we talk to our insurance partners, we hear pretty often they wish they knew more about all the automotive assets we have at J.D. Power. We have a legacy now of almost 60 years in the auto industry. So today and tomorrow, you'll hear more from us about the automotive assets that we have. And to kick that off, I'm going to introduce Matt Molnar to talk about what we see coming in the auto industry through our Power Information Network. Thank you, Matt.
Thank you. Good morning, everyone. So I was standing in the back and realized I don't have any AI references built into my presentation. So maybe we'll work one in somehow here. But really exciting things going on and good to be here. I've spent my entire career in the sales and loan origination space of the auto industry. So hearing what's going on in insurance is really exciting for me. So let's go ahead and dive in what's going to happen in the auto industry in 2026. And jump ahead here, make sure I have this working. Green button, right? There we go. All right, so Keith opened this morning talking about how it's been a very volatile time for the insurance industry. That's been the same for auto new sales for quite some time, as you can see here. So what we're looking at is new vehicle sales broken out by retail and non-retail over the past 7 years or so. And you can see we had in 21 and 22 around COVID, and as well as the supply chain crunch that I'm sure many of you are well aware of, industry sales dipped quite a bit. But the good news is last year we hit 13.6 million retail sales. You can see notable increase versus 2024 there, and 16.3 million total retail sales, which in both cases for those two metrics are the highest we observed since 2019. So the industry has kind of been building its way out of these supply crunch challenges that were generally speaking related to COVID. Now, 13.6 million, good number, but as I mentioned, last year was very volatile. A couple of reasons for that. One, we all know tariffs were introduced in the spring of last year. By our estimation, about 200,000 consumers rushed to the market and purchased new vehicles prior to the tariffs going into effect in early April of last year. So very unique environment, a pull-ahead demand event, as we typically call it, influenced that 13.6 number. On top of that, you may be aware the EV tax credit expired in September of last year as well. That pulled forward about 90,000 retail sales into the third quarter of last year as consumers were rushing to purchase EVs ahead of the $7,500 federal tax credit expiring. So the 13.6 number looks really good, but a lot of movement going on around that. And maybe last comment I'll make on sales before we start talking in detail about 2026 is you may see headlines in the media right now, industry sales down 10%, 15% year over year so far in 2026. That is simply, again, because we had such strong performance in the first 3 months of last year because of all of the tariff pull-ahead demand. So the first 3-4 months of the year so far are playing out almost exactly as we predicted from a retail sales perspective, and we'll talk about that more here in just a minute. So next here, what's going on with transaction prices? When we say transaction price, we're referring to the price that the consumer negotiates with their dealer, and then we subtract any OEM incentives that also apply to that transaction. And you can see overall, like most things in the economy, we're up about a little over a third in terms of transaction price from 2019 to where we landed in 2025. And we've been pretty level for the past several years around that $45,000, $46,000 transaction price point. So new vehicles in particular, still very expensive relative to historical standards. Now, one question you might be asking, and one that we've been addressing with clients quite a bit, is are did the tariffs actually raise vehicle prices? And you can see here, we're up 2% year over year. Generally speaking, the answer is no. Obviously, we're in a very competitive environment. So if one OEM raises their price, other OEMs who didn't raise their price are generally speaking going to pick up some of that volume. And so we saw several examples last year where, whether it was through reducing incentives or even raising MSRP in some cases, manufacturers tried to maybe pass through some of that tariff cost. And because of the competitive nature of the market, we saw their market share decline in very short order. And so a lot of them had to reverse those decisions. So that is one of the things that is keeping transaction prices relatively low and a fairly normal year-over-year increase in 2025, even with all of the tariffs that have been introduced. So high transaction prices, high monthly payments. In fact, monthly payments last year hit an all-time high. You can see we have it broken out by both finance and lease here. We're pushing $800 on a finance average monthly payment for a new vehicle and about $650 for lease. So affordability, I know, big conversation in the economy in general. That applies to insurance, obviously. It also applies here to vehicle monthly payments. We'll talk about this more in detail later on as well. So when we start talking about 2026 here in the next few slides, I just want to talk about what are the factors that are shaping the market. In 2025, we touched on a lot of these. Price uncertainty related to tariffs. So all of that pull-ahead demand, as we touched on earlier, consumers rushing to try to beat at least the expectation of higher new vehicle prices. Secondly, EV tax credit expiration. We already touched on that as well. A lot of OEMs put a lot of investment into electric vehicles. With the tax credit expiring, you may have seen in the media, a lot of OEMs are writing down some of that investment just because with higher transaction prices now, those EVs just aren't moving as quickly as they were. Didn't touch on this one in my first couple of slides, but we'll come back to it. Talking about falling interest rates. So that has actually been a little bit of a tailwind to the industry. We observed that in 2025. Time will tell what we'll see for the rest of 2026. You know, we have a Fed meeting tomorrow, new chair coming in next month, so we'll see what happens with interest rates. But ultimately, the biggest thing that all of our customers are asking us about, and obviously it's a conversation across the industry, is affordability concerns. So that was 2025. The situation looks somewhat similar, I'll say, as we move into 2026. So despite everything on the left-hand side of that view, we saw best retail as well as total industry sales since 2019. So what's going to influence 2026? First of all, global events and gas prices. A very recent development here with the Iran conflict. We've seen gas prices shoot up. We'll talk more on the next slide about what does that mean for sales for the industry. OEMs are adjusting to the new policy environment as well. So again, those EV investments were, we had a lot of OEMs pushing very hard on EV investments. With that tax credit gone, that changes the situation for them. Adjusting to tariffs, also a big conversation at all of the OEMs. Maybe they can't pass through that cost to the consumer, but how can they mitigate their tariff exposure? So we'll talk about that more as well. I have a question mark on falling interest rates. As I mentioned, we don't obviously know exactly what's going to happen there. I think the general consensus is we'll be flat to potentially down. So potential for a tailwind for the industry there. But again, it all comes back to affordability concerns. Still a challenge for the industry. And again, we'll see this in the data as we move through the next few slides. So next here, big question mark that's, again, just come up very recently here. Will higher gas prices influence sales numbers? And what we've done here is we've looked at the past, as you can see, 20 years or so, and we've tracked the average fuel price for the industry versus the new vehicle sales rate. And you can see that we've had a lot of events over the past 20 years that either put upward or downward pressure on new vehicle prices, on fuel prices. And generally speaking, you might have to squint a little bit, but you can see that there's not a strong correlation between how the price of fuel changes and what ultimately happens to new vehicle retail sales. Now, if we see $4 gasoline on a national average carry into the end of the year, that's where it's going to have more broader negative economic impact, and we could see some negative impact on sales. But generally speaking, if this is a relatively limited time frame around fuel price increases, we expect that the sales pace, at least in the short to medium term, won't be negatively impacted. Now, one last comment I'll make on this is we will see, and we're actually already starting to see, consumers shifting which vehicle they're purchasing as a result of higher fuel prices. So you can imagine that means smaller vehicles. We're seeing, particularly in the month of April so far, the compact car segment doing quite well. So consumers, while they may not necessarily put off their purchase completely, they may switch down in segment to get a more fuel-efficient vehicle, or obviously the alternative fuel types that have better fuel economy, such as hybrids, electric vehicles, may start to do a little bit better in terms of their share of the entire market. So long story short there, don't expect it to have a major impact on sales volume, but we will likely see customers shift around what type of vehicle from a fuel type perspective, and even which segment they're purchasing. So I mentioned the two big events in terms of policy changes that influenced the market last year. We're seeing OEMs adjust to this very quickly in terms of the vehicles they're producing and how they're supporting them from an incentives perspective. So the first was the tax credit expiring. You can see the trend over the past 7 years or so in terms of EV mix of new vehicle sales. And we had been on a sharp upward trend all the way through 2024 as OEMs were rushing, frankly, to catch up with Tesla. Tesla had done quite well in terms of gaining market share, and OEMs were rushing to get products to market to support or to keep some of their own consumers in their brand. On top of that, we did have the federal government tax credit out there, and that was supporting price as well. You can see things leveled off last year with, again, a lot of volatility. That market share of 8.9% reached a high point of 14.5% in September, right before the tax credit expired, and the low was about 5% at the end of the year, right after the tax credit had expired. So a lot of volatility around EVs in 2025. You can see our forecast for 2026 is a decline in market share to 7.3%. Again, OEMs adjusting their production plans as well as their incentives to just work with the reality that the new market is facing as a result of particularly the tax credit being expired, but also regulations around EV mix of sales, et cetera, that have also been removed. On the right-hand side, this is the tariff illustration for you here. So this is looking at the mix of U.S. produced sales that were, the mix of sales that were produced in the U.S. And this is for the first quarter of the year, trended over the past 6-7 years, as you can see there. And this year we hit 55% of sales were final assembled in the United States. You can see that's a record over that time frame and a notable upward move year over year. So OEMs, it's a bit of a large ship to turn, so they can't do it quickly necessarily, but we are seeing where they can, shifting production to the U.S. to mitigate some of that tariff exposure. Again, that obviously applies to vehicles that are final assembled outside of the U.S. So key thing is OEMs are adjusting to the market in this, or I should say reacting to these policy changes. Next here, so OEMs are reacting, they really are keeping their production flowing steadily as well. So you might think dialing back on EVs, maybe we're not seeing as much production of the other fuel types as they're trying to transition over. Not necessarily. You can see new vehicle inventory is at a 3-year high as of this month. So we are seeing inventory holding relatively steady. You can see it hasn't moved much year over year. in terms of total inventory. Now, keep in mind that we'll call it 2.2 million units of new vehicle inventory on dealer lots is still relatively depressed compared to what we observed pre-COVID. So around that time, we typically see around 3 million units of inventory on dealer lots. So this is still a relatively constrained number, and that is one of the reasons, if you look to the right-hand side, you'll see that the amount of incentive dollars that OEMs are putting on vehicles relative to MSRP is still fairly constrained. We're only at 6.6% right now, whereas, again, back in 2019, 2020, the norm was about 10%. So OEMs staying relatively disciplined with production. The sales pace is keeping up with the current level of production, and that's allowing them to keep incentives relatively constrained. I think one of the positives as we think about that incentive spending number for the rest of the year is OEMs have room to raise incentives if needed, if we do see a slowdown in the consumer. So generally speaking, a little bit of a tailwind there, but it's all going to come down to demand and supply, as we all know. So overall, kind of talked about here how gas prices likely to have minimal impact to sales. OEMs are maintaining their discipline with production. Incentives are relatively low. They have some opportunity to raise it. They're also adapting to the new regulatory environment. So everything sounds great, right? Not necessarily. There are some maybe concerns or warning signs going on in the industry that we need to think about for the rest of the year. So first of all, I'm sorry, I forgot to mention this one. Falling interest rates are also another tailwind. So you can see here we're looking at the average new loan APR for a 740 plus FICO consumer, that super prime consumer. And we have it broken out by several different loan terms there. You can see that particularly for the 60 and 72 month terms, we're down close to 100 basis points year over year in terms of the average interest rate. So that obviously helps with monthly payments, as we were discussing earlier. Even 84-month loans, which, as we'll see in a moment, are becoming more and more popular as consumers are, again, trying to make that monthly payment work in their budget. You can see 84-month loan interest rates are also down about 50 basis points year over year as well. So this is another tailwind that is helping the industry and keeping that sales pace going strong, as we saw earlier. Now, here's where we get to the challenges that are facing the market this year. So first of all, falling trade-in equity is a headwind to the market. So you'll see, again, a lot of volatility in this trend in terms of the average consumer that is trading in a vehicle. What is their equity in that vehicle that they're rolling into their new transaction? And you can see that in 2022, when new vehicle and used vehicle supply was effectively at its low point. It was a great opportunity to be selling a used car if you were in the market then in 2022, almost $10,000 of average trade-in equity. But as particularly the new vehicle market inventory has recovered, you can see average trade equity has fallen quite a bit. So far this year, we're at about $6,800 versus $7,200 last year. So I'll draw your attention back to what we were talking about with transaction prices. Yes, transaction prices are about the same as they were back in 2022, but the average consumer who was coming back to market with a trade had about $3,000 more trade equity to put into that new transaction versus that very similar transaction price. So another factor that is a headwind for the industry, particularly from an affordability concern, this is a trend that we're watching and updating quite closely. Now, is this situation going to get better or worse? Our forecast is actually, as we move through the rest of the year, used vehicle prices will fall by about 4% through the rest of the calendar year. And so we'll talk about one of the reasons for that on this slide here. So this is looking at the number of consumers that are scheduled to turn in a lease. Their 36-month, whatever term it was, lease is ending. And if you zoom in on that 2025 window there, you can see we had a sharp fall off over that time frame. Very few of those younger used vehicles coming back to market. Why was that? Well, first of all, 3 years prior was the peak of the supply crunch when we weren't even selling a lot of vehicles. But at the same time, we had OEMs who felt no need to incentivize, and therefore not only were we selling fewer, but those vehicles weren't being leased because there are no lease incentives. You're not generally going to see a lot of lease volume. So we really, in the second half of last year, were at the absolute bottom of scheduled returning lessees. Now we are right in the middle of digging our way out of that bottom or that pit, whatever you want to call it, and starting to see a relative return to normal. And so this is one of the main factors that is going to influence used vehicle prices through the rest of the year. We're just going to have more supply of those younger used units coming back online, and more supply will push prices down is our expectation. Another factor that we're watching quite closely and important to be aware of, and frankly a bit of a maybe risk as we look at the rest of the year, is subprime FICO retail sales mix. So this lower FICO consumer, you can see particularly in the past 6 months or so, has really stepped up their participation in the new vehicle market. I would argue the biggest reason for that is credit availability is improving. So as we've seen interest rates start to come down, we had a few cuts last year. We saw banks more willing to lend at extended terms, higher loan to values, and frankly to the subprime FICO consumer as well. So 11.4% of industry retail sales so far this month. This data is actually as of a few days ago. So, but nonetheless, 11.4% mix of sales, whereas the past couple of years, that subprime buyer had not really been a large mix of the market. One other thing, and I don't have a visual of this, but I just wanted to call out for you as well, is I mentioned those 200,000 pull-ahead sales that happened in the first quarter of last year due to tariffs. Those pull-ahead consumers were overwhelmingly high FICO, high-income consumers. Call it your more savvy consumer that rushed into the market to try to beat tariffs. So that's another factor that is somewhat influencing this higher subprime FICO mix. But another thing to keep in mind is that this 11.4%, it's not incredibly elevated relative to pre-COVID norms. We would, generally speaking, bounce around between 10 and 12%, but nonetheless, still a significantly elevated number relative to what we observed for the past couple of years. All right, so next here, and I touched on this briefly earlier on, but loan metrics are skewing higher risk. So if we think about trade equity also being a challenge, if you think about a consumer and insuring their purchase, these are things that are going to impact their overall positioning in that vehicle. So I mentioned 84-month loans are becoming more popular. You can see the trend there over the past few years. We're almost at 14% so far this month in terms of 84-month loan term mix. We all know 84-month loan, the longer you stretch out the term, the longer it's going to take for you to build an equity position in that vehicle. So not as much of an issue for purchases happening right now necessarily, but when those consumers do come back to market, that's where there's going to be a challenge from making the monthly payment work. Loan to values are also increasing. You can see the average loan to value over the past 3 years is up about 7%. So we're seeing that impact of transaction prices remaining high, but trade equity being lower, consumers financing a larger portion of their purchase. So another challenging situation there. And all this adds up to monthly payments, even with that 84-month term mix going up. Because prices remain high, because loan to values are rising, we're seeing monthly payments in the past 3 or 4 months hanging right about, if not above, $800 a month on the finance side. So again, we're not raising alarm bells on some of these metrics, but it is something to watch in terms of, can these trends be sustained as we move forward through the rest of the year? I think we would welcome that higher income, higher FICO buyer coming back and being a larger portion of the market. Now, if you have those consumers that are financing more at longer terms, taking longer to build equity positions, the good news is we're seeing consumers take steps to protect themselves in that situation. So this is looking at gap insurance penetration, and we have it broken out by loan term here. Obviously, the shorter you go in term, the less a gap protection plan is necessary. But even these 84-month consumers, you can see they're almost 60% so far in April are taking some kind of gap product to, again, protect them in a situation where they do total their vehicle. The payoff is significantly lower than their loan balance. And you can see 75 months trending up as well. A little bit less on 72, but still seeing a bit of an increase there. Okay, so have a few minutes left here just to sum it all up for you, what we're thinking about in terms of sales drivers for the year. So there are a lot of puts and takes, and I'll go through these, and we touched on all of them already. But EV credits being eliminated is going to weigh down or have downward pressure on the industry just because those vehicles that are selling do have higher prices. Lower trade equity, also a negative impact on the industry. We already touched on that in quite a bit of detail there as well. The subprime credit availability, as I mentioned, it's not necessarily a bad thing and significantly outside of historical norms. But if we're going to see the industry sales pace continue to be relatively strong, we're going to need either the credit availability to maintain where it is today, or again, those higher FICO, higher income consumers start to step up in the market. Lower interest rates, again, I think anyone who's been trying to predict the pace or the direction of interest rates over the past few years has not looked very smart, but we are generally expecting lower interest rates as the economy continues to just adjust from very high interest rates that we had over the past few years. Higher lease returns will boost new vehicle sales as well. So with more returning lessees coming back to market, we expect they're going to get into another vehicle and likely lease again as well. We're actually already observing some of that behavior. Production and price discipline, fairly neutral. And then the wild card, which no one can predict here, is economic uncertainty. That can, generally speaking, the risk to that looks down to the downside as we consider everything going on with the Iran conflict as well as gas prices. So what is our forecast for the entire year? Have a couple minutes left. We'll just wrap up with this. So we're forecasting the industry actually to hold up quite well. You can see 13.6 million on the retail side. We expect the fleet or non-retail channel to hang out at about 2.7 million. Now, if, again, we continue to see gas prices stay elevated for a significant period of time here, there probably is more downside than upside risk to that 13.6 number. But the year so far, as I mentioned, is playing out almost exactly as we predicted going into the year from a sales perspective. So we're holding to that 13.6 right now. Could change in the next few months, but that's going to be driven by market factors. We do expect transaction prices to also rise. Historically, we see transaction prices increase with the pace of inflation. In this case, we're forecasting about a 1.7% increase in transaction prices. So call it relatively in line with what we typically see for the market, but definitely not a downward move expected for the industry here. Now, one of the things that is going to keep those transaction prices increases relatively limited is OEMs, we expect, will start to incentivize more. So when we talked about inventory and incentives relative to MSRP, if we do see that inventory continuing to build, the industry right now is 60 to 70 days of supply, which is historically a level where OEMs get a little less comfortable with having that much inventory sitting on dealer lots. That's where we may see incentives start to tick up, and we're expecting that as we move through the rest of the year. And this is just to wrap up here, looking at consumer expenditure. This is taking price times volume. So what is the total amount of dollars that consumers are spending on new vehicles? Higher transaction price with flat sales leads to a very minimal, as you can see there, increase, but over $630 billion of consumer dollars being spent on new vehicles this year. And not as relevant for our conversation today, but we usually talk about it thinking about dealer profitability. You can see we're forecasting dealer profit will decline as they also discount vehicles moving into the rest of the year, again, to keep those inventory levels relatively balanced. So, and maybe the last comment I'll make is that $25 billion still historically elevated in terms of total dealer profitability relative to the number of vehicles sold. So, yes, it's trending down, but as we all know, if you bought a car in 2022 or 2023, you were seeing markups above MSRP, so those prior numbers were very inflated. So I'm right up at time here. Happy, I'll be hanging out for a little bit if anyone has any questions or anything you'd like to discuss, but that's everything I have on 2026 for the industry. Thank you.